Hey everyone, and welcome to This Explainer. Right now, we are looking at a mid-2026 financial landscape that is, quite frankly, totally unprecedented. We've got a lot of moving parts, some seriously incredible data, and just massive macroeconomic forces at play here. So my goal today is to systematically unpack all this complex market data with you, step by step, so we can get a crystal clear understanding of exactly what is happening out there in the global markets. Because, look, it's the multi-trillion-dollar question we all have to ask ourselves. What actually happens when an AI stock bubble just straight up collides with the crypto market? As we sit here in 2026, we aren't just looking at isolated market movements anymore. No, we are watching a massive, high-stakes collision between traditional equities and digital assets. It's fascinating, it's highly volatile, and understanding it is absolutely critical if you want to navigate what comes next. Okay, let's dive into this. We're going to unpack this chaos into 5 clear segments. First, the 2026 equity bubble. 2. Crypto's risk-on synergy. 3. Inflation and digital gold. 4. The sector winners and losers. And finally, 5. The contagion threat. Let's start right off with our first section, the 2026 equity bubble, where AI and biotech are literally fueling an absolute frenzy. To truly understand crypto right now, you first have to look at the traditional stock market. We are in the middle of a massive, unprecedented equity bubble. And what's driving it? Well, it's largely fueled by this hyper-growth in decentralized AI infrastructure and biotech sectors. These industries are just expanding at a breakneck pace. But here is the critical part for our analysis today. Because of this massive stock surge, the relationship between equities and cryptocurrencies is entering what analysts call a critical decoupling phase. It's a chaotic environment, and it's causing extremely high market volatility across the board. Actually, this massive traditional bubble is basically the literal springboard for everything happening in the digital asset space right now. Moving on to Section 2, Crypto's Risk-on Synergy. Let's look at the overflow effect and how all this stock market money is fundamentally altering crypto. And this brilliantly illustrates the point. In the early stages of this 2026 equity surge, we saw a staggering correlation coefficient, an R value of roughly 0.85 between Bitcoin, Ethereum, and the surging Nasdaq. To put that into perspective, what it means is that as investors were desperately chasing high yields in tech stocks, all that overflow capital just flooded directly into the crypto market. It was a massive wave of money that actually pushed Bitcoin toward entirely new institutional price floors. This quote right here gets straight to the heart of the institutional mindset. Traditional price-to-earnings, or PE ratios, have hit historic highs. So, if you're a hedge fund manager, traditional stocks are looking incredibly expensive. To compensate for that, institutional FOMO, the fear of missing out, has really kicked in. They've shifted to utilizing crypto as a high beta play. In plain English, they are literally using the natural volatility of crypto purely as an aggressive tool to beat the returns of the S&P 500. They are riding the crypto wave just to juice their traditional portfolios. But it's not just a blind money grab, right? It's highly targeted. The 2026 bubble is, at its core, an AI bubble. And that brings us to DePIN. That stands for Decentralized Physical Infrastructure Networks. Basically, these are crypto projects that provide decentralized compute power. And since the world is absolutely starved for computing power right now, DePIN tokens have seen their prices just skyrocket right alongside traditional AI chip makers. The convergence here is undeniable. Crypto infrastructure is literally being treated as AI infrastructure. All right, Section 3, Inflation and Digital Gold. This is where overheating markets are forcing the hand of hawkish central banks. So this overheating stock bubble has triggered some serious systemic problems, forcing the Federal Reserve into a really tight, hawkish stance just to fight off inflation. Think about it like this. On the traditional finance side, we have an expanding fiat currency supply to support government infrastructure projects, paired with your standard stock dividends. But contrast that with crypto and DeFi. Bitcoin has a strictly fixed supply of 21 million coins. Because of this, and unlike the 2021 cycle, 2026 has seen Bitcoin act heavily as a debased currency hedge. Institutions are gladly paying a premium for its scarcity. Plus, while stocks offer traditional dividends, the decentralized finance, or DeFi sector in 2026 is offering what investors call real yield through automated market makers. This dynamic is actually pulling precious liquidity away from traditional bond markets and straight into the crypto ecosystem. Now for Section 4, Sector Winners and Losers. Let's look at the pragmatic ground truth of where this money is actually going. Now, what's really interesting here is the stark contrast in the data. Not all crypto is benefiting equally from this overflow capital.
Layer 1s like Bitcoin, Ethereum, and Solana are seeing a strong bullish trend because they act as the reserve assets for the digital economy. DePIN, as we just discussed, is going completely parabolic due to its direct correlation with the AI frenzy. Stablecoins are showing high velocity, acting as the primary on-ramp for sidelined equity gains just waiting to be deployed. But look at the bottom row. Metaverse and NFTs are totally stagnant. Sorry to the digital rock collectors out there, but capital has decisively shifted toward hardcore utility and moved entirely away from speculative digital art.
And that brings us to our final and, frankly, most important section, the contagion threat. Let's look at the anatomy of a potential collapse. I want to slow down the pacing here for a second because the systemic risks building up in late 2026 are incredibly severe. To really understand the threat, we have to define a very specific piece of financial jargon, a Minsky moment. This is a sudden major collapse of asset values, which is just part of the normal credit of business cycle. It usually happens after long periods of bullish speculation when investors have simply taken on way too much debt. And analysts are warning that a Minsky moment is the primary risk hovering over late 2026 right now.
If that Minsky moment arrives, here is the exact step-by-step chain reaction of how the contagion spreads. Domino number 1, the traditional equity bubble bursts. Tech and AI stocks plummet. Domino number 2, this flash crash triggers massive margin calls across the traditional finance sector. Institutional investors are suddenly forced to come up with cash immediately to cover their traditional portfolio losses, which leads to domino number 3. To get that cash, institutions have to liquidate their most profitable and liquid assets. And right now, that asset is crypto. So, a traditional market flash crash mathematically guarantees a massive, severe liquidity drain and a huge sell-off in the crypto markets.
Summarizing, where we stand as of May 2026, crypto prices are riding the massive wave of the equity bubble, sitting right at all-time highs. However, analysts are warning that the market is dangerously top-heavy. We are seeing an extreme divergence between asset prices and their fundamental underlying value. It's kind of reaching a breaking point. Because of this, the smart money, the major institutional players, have enacted a major strategy shift. They are no longer in an accumulation phase. Their focus has entirely shifted to capital preservation. They are bracing for impact.
So the crucial point is knowing exactly what to look out for. And the data gives us a very specific indicator. This is your key metric to watch, the BTC to S&P 500 ratio. If you see this ratio begin to spike aggressively while the broader S&P 500 plateaus or stalls out, you need to pay very close attention. That specific divergence indicates the final speculative blow off top right before a potential systemic market correction.
I want to leave you with this final thought to ponder today. We've seen the data, we've tracked the overflow from the AI bubble, and we know the exact mechanism of the contagion threat. So I ask you, if the BTC to S&P 500 ratio spikes while equities plateau, are you prepared for the systemic correction? Thank you so much for joining me today for this explainer. Keep your eyes on those charts, stay focused, and never stop learning. I'll catch you next time.